about the homework.
Oh, yeah, sure.
So I noticed that chapter 1 and 2 are due next Monday. Is it kind of staged to where the homework is due after we have class?
More or
So
less.
like we went over chapter, so it's kind of we could use the class as a preview to then go into the study material.
Yes, you can do that if you like. Yes. Okay.
Okay.
Okay. By the way, I'm now recording. So hello, everyone. This is day 2 of our SIE review. I didn't have a chance to record day 1, but hopefully that will be still fresh in your minds. Hopefully we'll get this video rendered and recorded and uploaded. Okay, so we'll have this available for you to review on later on. And yeah, like I said, now ideally, of course, it's best to read through the material first and then come to class. This works better as a review. But if you didn't have a chance to read the material yet or go through it, that's okay too, right? Then this can be a preview, like I said, a preview of what you're about to read in the material. So, hey, that's what that guy was talking about. Okay. Kimberly, I think your hand is raised.
Yes, I noticed that on the dashboard of the Past Perfect software, it looks like for the score for the end of the understanding your knowledge questions, based on how many times you take it, it looks like it's giving you an average score.
Oh, okay. I didn't think it would give you an average. I kind of thought it would just sort of sum things up. But
so, and you only have to score at least a 70 one time, right? So like I did one and I bombed the first 2, and then I got a 70 on the third one.
Okay.
So it shows my average is still not at 70, but I did score 70 on one of the 3.
All right. Well, that's good enough for me. That's good enough to score points.
Okay, so where does that go somewhere where you see that my 170, or are you only going to see the average, or where do you see from the teacher's view when you're looking for our grades?
Yeah, I have to log into the Past Perfect system. Now, keep in mind, by the way, right? This is the first time we're using Past Perfect as our materials provider. We previously used Kaplan, so I'm a little new to the system myself.
Okay.
So I might have to figure out how. Now, like I said, as long as I see him actually score at least a 70% at least one time, I'm all good with that. Okay, and that's enough to put some points on the board.
Thank you.
Okay, but you see it shows an average, is that right?
It shows an average when you go into the dashboard. On your dashboard, there's one where you can do the breakdown, and I'll go on a break. I'll go look at it, what it's actually called. But yeah, you have to. When you break it down, it shows it looks like what's an average score. And then if you click on that, it shows you all the attempts.
Gotcha. Okay, good. All right. Sounds good. Okay, well, thanks for bringing that up. All right. So what we did last time, we talked about equity securities, which, of course, the word equity means ownership, and ownership means stocks. So you own shares of stock in the company. So when you own shares of stock in the company, you're a part owner of that company. And as a part owner of the company, one, of course, you hope to participate in the growth of the company. As the company grows, we're also hoping the value of their stocks grow too. And maybe you'll be able to sell the stock and let them appreciate, especially over a long period of time. Of course, you have the risk of stocks, which of course included some market risk and a lot of volatility. Volatility refers to up and down price swings. So that is some of the risk of owning stocks. Most of the stocks you're talking about are called common stocks. In fact, common stock is so common, pretty much anytime you talk about stocks, you're talking about common stock. Okay. All right. But some companies issue another type called a preferred stock. A preferred stock gets some preferential treatment over common stock in 2 main places. First is when it comes to dividend payments, like we talked about earlier. Preferred stockholders must receive their dividend and receive it in full before the company can pay dividends to common stockholders. That's why only right if they don't have enough money, preferred stocks get their dividends, common stockholders don't. Being they're still dividends, right? They're not interest. They look and act like bonds, but they're not bonds. Bonds are debts. Okay, and they pay interest, and there's a legal obligation to repay debts with interest. There is no legal obligation to pay a dividend. It's still at the discretion of the company's board of directors. And the board could decide if they're having cash flow problems, they should either reduce or even skip over dividend payments, even for preferred stocks too. The other preferential treatment they get, it comes to a bankruptcy liquidation. If the company is declared bankrupt and the bankruptcy judge says you have to sell everything, okay, that's called liquidation bankruptcy, then Sorry, hold on. Sorry about that. Okay. So it's called the liquidation bankruptcy, and everything they have to sell, right? They have to pay off their debts first, but then whatever's left over, preferred stocks get the proceeds. Last in line are common stockholders. If there's anything left at that point, and don't hold your breath. All right, so then we're going to talk about today, we're going to go into some special type of securities. Let me go in and get those. And these are known as derivative instruments. All right, so they're special, they're collectively known as derivatives. Let me write that out for you here. Okay, and they get the name derivatives because they derive their value based on the value of something else. Basically, it's the value of the company's common stock. So they issue a few different types of securities that base their value on the value of the company's common stocks. Now, they include rights and warrants, options also, but we'll talk about options in another chapter, and also including American depository receipts. Okay, now warrants. A warrant is given to, they're usually offered as attached to a bond offering. So they offer them as a deal sweep. They say, if you buy our bonds, we'll throw a warrant in along with it. A warrant gives whoever has one an ability, basically the right to buy a share of the company's common stock at a pre-agreed fixed price, at a locked-in price. Now, only for a certain period of time, but that time can be several years. Now, the price, the exercise price or subscription price, is above, it's higher than the market price at the time the warrants are offered. So maybe the stock's currently trading for $35, but they throw in these warrants that say you can buy them for $50. Now, that doesn't sound too exciting to buy something for $50 that's worth $35. But a warrant might last for years, maybe 5 years, maybe longer. Well, what if 5 years later, now the stock's like $75 a share, and you've got a warrant that lets you buy it at $50? Now you've got something, right? You've got something with some value to it. In fact, that would be called intrinsic value. Intrinsic value meaning built-in profitability. You can buy it at $50 and it's worth $75. That's an instant $25 profit, or $25 of intrinsic value. Okay. Now, warrants, they're also a tradable financial instrument. And warrants are also listed and traded on the stock exchange too, usually on the same stock exchange as the underlying stock itself. And people might actually trade the warrants sometimes as a substitute for the actual stock, because the price of a warrant is probably lower than the price of the actual stock, but still lets you participate in the potential growth of the underlying stock. Just a real life example, but before they expired, Intel had warrants issue outstanding. Now, they came along with their initial stock offering. So anyone who got in ground floor on Intel, not only did they get a share of stock, but they got a warrant along with it, which lets them buy another share of Intel at a fixed price. Well, they really did well for themselves. But people used to trade the Intel warrants as a substitute for trading the actual Intel stock. Because Intel stock at the time, it might have been like $90 a share, but the warrants might have been like $40. So it was like a cheaper way of still investing and participating in the growth of Intel. Now, owning the warrant didn't mean they owned the stock itself, right? They just owned an instrument that gave them the chance to buy Intel stock at a fixed price. It's not the same as owning the stock. So they don't receive dividends. They don't receive voting rights. They're not actually stockholders. But it's basically like a substitute for the stock itself. Okay, so warrants given as a deal sweetener can have a long time, right? Several years until they expire. And the exercise price is set above the current price at the time the warrants are issued. Another derivatives are called rights. Now, rights also give someone the ability to buy shares of the company stock at a fixed price. But the price that they can buy it for, the subscription price, is lower than the current price at the time it's issued. Now, rights are done in a rights offering. And this happens when a company has sold shares of stock to investors, right? They've ordered to raise capital. Now they want to sell more shares to raise more capital. They want another round of financing. They'll give existing shareholders the first chance to buy those newly issued shares. You might remember this before also, that common stockholders have preemptive rights. That means if the company issues more shares of stock, existing shareholders get the first right of refusal to buy those newly issued shares. Why do they do that? Is because it allows them a chance to maintain their percentage of ownership of the company. Let's say someone owned like 5% of the company's stock, and now the company is going to do another round of financing and issue more shares of stock. Well, Otherwise, right, whoever owns, if they own 5% and there are more shares now, they won't own 5% anymore. It'd be something less than that. There'd be some dilution. But the rights offering gives them a chance to buy more shares of the company stock and to make it even more attractive offer at a price that's below the market price, at least at the time the warrants are issued. I'm sorry, the rights are issued. Now, they only have a little bit of time to make up their minds if they want to take them up on the offer or not. So they usually expire, like, okay, the slide says 30 to 60 days. I usually see about 30 to 45 days. 60 days seems to be kind of outside, really. Okay, but again, they have intrinsic value or built-in profitability when they're issued. Now, what happens is every investor receives one right for every share that they own. And then based on the deal, and deals will be different, but however, it'll take a certain number of rights to buy additional shares of the company stock. So maybe it'll take every 20 rights you have the chance to buy one more share of company stock at the locked-in fixed price. Do people have to use their rights? Not at all. It's a right. It's not an obligation. They have the choice to either exercise the right, like a contract, and buy more shares of the stock, or they could sell the rights, because the rights are also going to trade on the stock exchanges, and the price of the right is going to move probably pretty much lockstep along with the underlying stock, right? Deriving its value from the value of the company's common stock. Or they could just do nothing and let them expire. And no, I can't think of a good reason to let them expire. If you don't want to take them up on the deal, sell them and get the cash. Okay, now here's another one, is American Depository Receipts. And you'll often see that abbreviated as ADRs. So American Depository Receipts, these are shares of foreign stocks traded on a foreign stock exchange that have been repackaged for U.S. investors to make it a lot easier for U.S. investors to buy and sell shares of foreign companies. Let's say someone wants to invest in Toyota. Okay, now they can buy the Toyota ordinary shares, right, traded on the Tokyo Stock Exchange, but they might have to open a Japanese brokerage firm and can wire currency over and convert to currency. Might take a fair amount of work. Or they could buy the American Depository Receipts, which are listed and traded on the New York Stock Exchange, making a much easier way for a U.S. investor interested in buying foreign companies. So what happens is that a U.S. company, a U.S. bank, a multinational bank, like Chase, for example, I understand is really big on this. They'll buy shares of Toyota on the Tokyo Stock Exchange and hold the shares in their vaults. Then the bank will then issue receipts on the shares that they hold in their vaults, basically saying you have a claim on what we hold in the vaults. And now the receipts are then listed and traded in the U.S. markets, on New York or NASDAQ. So it makes it a much more easy and convenient way. Now, as such, by the way, they don't actually own the stock, right? They have a receipt on the stock itself. So they do not receive voting rights or preemptive rights unless, the bank that holds them basically forwards those rights to the holders of ADRs. More than that, any information that they get, company reports, well, they have to be translated to English. Now, ADRs also listed on stock exchange. They are bought and sold. They are priced in U.S. dollars, and they pay dividends in U.S. dollars, which means there is a currency risk, because when Toyota pays its dividend, it's going to pay in yen, which are going to have to be converted into U.S. dollars. And if the exchange rates become less favorable, you won't get as many dollars for the same amount of yen. So there is a certain exchange rate or currency risk to owning ADRs. Okay. ADRs are indeed registered with the stock exchange, and if they're listed on a stock exchange, they are sponsored, right, by a multinational bank. Occasionally use the word as ADSs, American Depository Shares. Some that are not sponsored, instead of trading on a stock exchange, are traded in the over-the-counter market. Right? Those are basically investments that can't be listed or traded on a stock exchange. All right, as we said here, the dividends are declared in foreign currency, but paid in U.S. dollars, but may be subject to foreign tax withholding. So, for example, shares of the Toyota ADR, it pays a dividend. Well, the country of Japan might keep 10% or something like that for local taxes. However, now that is something that is deductible on your U.S. taxes. So in that sense, you'll get the money back, but you do have to wait, right, until you get your tax returns. It does mention that capital gains are taxable. Remember what capital gains are? Trading profits. So if you buy an investment and sell it for more than you paid for it, your profits are called capital gains. Those are subject to tax too. We'll talk about taxes later, but often can be taxed at a lower rate. Of course, if you sell an investment for less than you paid for it, that's called a capital loss. All right, with that in mind, okay, we basically got through our part on equity securities. Even though they're usually called stockbrokers, stocks don't actually come up very much on the test. They're not as heavily tested as other financial instruments. One that is heavily tested, though, are bonds. Okay, so we want to now talk about debt securities. This is going to cover a lot of ground, so we're going to have a chance to talk about this quite a bit. Okay, because it is rather heavily tested. So bonds are debt securities, which means that an issuer, usually a corporation, but it could be a government entity also, needs capital, needs funding. And so they'll raise funding by issuing bonds. And since they're debt securities, so they basically are borrowing money from investors and promise to pay them back with interest. A bond is the evidence of that loan. That's effectively what a bond is. It's an IOU. Right. That's what a bond is. An IOU, which means, right? I owe you some money. That's the essence of what a bond is. It's a debt security. So the person who buys a bond is a creditor, okay, right? Is a lender or a creditor to the issuer. The bond issuer, whether it's a corporation or a government body, is the debtor borrowing money from them. So it's also a fixed income security, also like preferred stocks. They're both fixed income investments. Fixed income means that investors know exactly how much money they're supposed to receive, exactly how often, and it's not supposed to change. It's locked in at paying a certain income or a certain rate of return on a regular basis. Bonds pay interest and a fixed rate of interest. So it's going to be locked in at that interest rate. Preferred stocks pay dividends also at a locked-in rate, again, which never changes. Now, when bonds are issued, they are sold to each investor. They're basically borrowing money from them, and they're sold at $1,000 a piece. Every bond has what's called a face value, also called a par value, also called a principal amount. Let me write that one out for you, too. A principal of $1,000. So every bond is a loan for $10,000. If someone buys 10 bonds, they are lending the issuer, a corporation or government, $10,000, which they promise to pay back with interest. This is a safe assumption for the test, that every bond has a face amount or a par value of $1,000. So you can always assume, unless you're specifically told otherwise, and I really doubt you'll be told otherwise. So the ground floor investors buy the bonds at $1,000, lending someone $10,000, and they'll pay them back later on plus interest. Now, the interest rate that it pays is also fixed when the bond is created. Right? And it's a rate of return, it's the annualized return based on the par value, percentage of that par value. Yes, Karina?
What is the reason for bonds having a face value of 1,000? Like, why is that always assumed?
Well, it's assumed because it's an industry standard, and because that's just the way everybody does it. I don't know why it's $1,000. I guess it just seemed like a good idea.
Thank you.
Oh, sure thing. I mean, after all, because they may be raising like millions and millions of dollars by issuing bonds at $1,000 a piece. Okay. So the interest rate that it pays is stated when the bond is created, and it's fixed. It's locked in when the bond is created. So if I said it was a 10% bond, here's our example here. A 10% bond is 10% of $1,000. Now, what is 10% of $1,000? Now, you can crunch that in your calculator, right? You can go like, 0.1 times 1,000, and that would give you 100. Okay, $100 per year. A 5% bond, like it says here, pays $50 a year, 5% of $1,000. Now that you can do it with your calculator, but here's an easier way. Take the number you see, take the interest rate that it pays, erase the percent sign, and then move the decimal point one place to the right. That's why if it's a 10% bond, it pays $100. What if I said it was a 6.5% bond? How much does that pay in interest every year? 6.5% of $1,000. Now, rather than use your calculator, just erase the percent sign, move the decimal one place to the right, it pays $65 per year. How about if I said it was a 4 3/4% bond? How much does that pay per year? Well, first off, you see it in fractional format. So first step, change fraction to decimal. What is 3/4 in decimal format? Well, 3/4 is 0.75. Use your calculator if you need to. 3 divided by 4 is 0.75. So it's 4.75% per year. So now, erase the percent sign and move the decimal one to the right. It pays $47.50 per year. And how about, okay, how about this one? A 8 5/8% bond. Okay, can you help me out with this one? 8 5/8%. So first off, convert fraction to decimal. What is 5/8 in decimal form?
0.625.
0.625, yes. So it's 8.625, right, percent per year. Percent. Now erase the percent sign, move the decimal one to the right, $86.25 per year. Now the convention again, so again, industry standards, is that the interest rate that it pays is a percentage of the par value in fractions of an eighth. And they always go to the least common denominator. So it'll be 8 1/8, 8 1/4, 8 3/8, 8 1/2, and so on. Now, by the way, the interest rate that it pays is sometimes called, again, something you remember, there may be several names for the same thing, right? Just the way the industry works. It could be called the stated interest rate, or it could be called the coupon rate. Now, the reason why it's called a coupon is because it used to be bonds were issued on fancy pieces of paper that had tear-off coupons attached to them. And whenever it was time to collect an interest payment, you tear off a coupon, take it to the bank, and they give you your interest payment. Now, they don't use tear-off coupons anymore, but the name sticks. So the interest rate is sometimes called the coupon rate, and each interest payment that you collect is sometimes called the coupon payment. Okay, even though they don't actually use tear-off coupons anymore, it's still useful as a metaphor, because while they don't use the mechanism is still basically the same. So when it makes its interest payment, right, whoever owns the bond tears off the coupon and collects a fixed payment. It's also, by the way, also known as its nominal yield. The nominal yield. Now, the word nominal means named, right? It's the named interest rate. Okay, and that's created when the bond is created. In fact, if you had the fancy piece of paper, it might say right on the front, on the face of the certificate, 8 5/8% or 7 3/4%, whatever it is. So the named interest rate is locked in and never changes. Knowing the nominal yield is useful because it tells you how much the bondholder should expect to collect in interest payments every year. Okay, so nominal, like nombre, name. Okay, it's a named interest rate. Okay, so now bonds might be issued in several structures. Now maybe a company does, a corporation, they want to borrow money from investors. They want to build, $100 million or something, and they're going to borrow money from investors and pay them back at a certain time. So that might be called a term bond. In a term bond, let's just say they want to raise $100 million. Okay, $100 million in 2023, and then the bonds come due, they'll mature, right, and they'll pay back their $100 million in 2033. So all the bonds that they issue, all $100 million worth, have the same start date and the same stop date. So they call that a term bond. Now, when you're trading something, because you see, bonds can be bought and sold, right? There's a marketplace for them, and if you trade something or buy and sell them, you got to put a price tag on. Now, the way the price is quoted, right? Again, this is just, again, the industry standard is that the price you get, the number you see, is the percentage of its par value. Right? It's like a shorthand notation. So if I said the price was 98, okay, so the price quote is 98. That's a shorthand way of saying 98% of the par value. Now, how much is the par value of a bond? It's standardized that it's $1,000. Again, safe assumption, unless you're specifically told otherwise. So it's 98% of $1,000. Now, how much is 98% of $1,000? Now, again, you can get your calculator. You can go 0.98 times 1,000, and that would give you 980. But there's a faster way. Take the number you see, take the 98, and move the decimal point one place to the right. So 98 turns into $980. That's an easier way to do it. It'll save you some time on the test. Anything that saves you time on the test is always a good thing. Okay, so if I told you the price, let me try another one here. The price is 102.5. What does that translate to into dollars and cents? Who can tell me?
$1,025.
Nicely done. $1,025. Good. Okay. What if I told you the price was, let's see, 96 3/4? Yes, Karina?
When you say the price, do you mean just the percentage of the part?
Well, that's how they do it, right? Then when they give you a price quote, the number they give you represents the percentage of its par value. So
Okay.
Yeah. So the price quote of 96 3/4, just a shorthand for 96 3/4%. Now, just like we did before, the first step is to convert fraction into decimal. Right, Amy? 96.75 percentage of par value. Well, now that we see it in decimal format, what does it translate to into dollars and cents?
$967.50.
$967.50. Perfect. That's it. That's all you got to do. Okay, so that's the convention for term bonds. When they give you a price quote, the price quote is a percentage of par value. That's why they're sometimes called dollar bonds too, because they quote in what translates into dollars and cents. Okay. Now, by the way, there wasn't a slide on this. Let me see if let me just go back real quick. Now, it didn't actually tell me this, because I said that the bonds pay interest, right, as a percentage of its par value, but how often do bonds pay interest? How often do you tear off a coupon, take it to the bank, and collect your interest payment? This is a safe assumption for the test, unless you're specifically told otherwise. Bonds pay interest semi-annually. That means every 6 months or twice a year. So it'll be locked in, right? Pay every January, July, or every February, August, March, September, and so on. So when they get an interest payment, like I said, if the stated rate here, like for example, is a 5% bond, it pays $50 a year. So that's going to come in the form of two, right, $25 payments, right, spaced 6 months apart. Okay, and they'll just keep on cranking out $25 payments, tear off the coupon, collect $25 every 6 months until the bond's maturity date. Okay. Now, when the bond matures, by the way, that's the date that the loan comes due, and that the issuer or corporation or government is going to repay their debts, right? Give investors their $1,000 back. It's also the day they tear off the last coupon. So the very last coupon is on maturity date. So when the bond matures, they'll get the principal amount of $1,000 back and the final semi-annual interest payment. So when this $1,000 bond matures, the bondholder gets a check for $1,025. Now, again, as I said, it's a safe assumption unless you're told otherwise. Bonds pay interest every 6 months. Here's a place you might be told otherwise, and that's a zero coupon bond. Right? This is a bond that doesn't have tear-off coupons. You don't receive regular interest payments from them. So they don't get a collective check every 6 months. In that case, how do investors make money with a zero coupon bond? The way they make money with them is that they're purchased at a deep discount from its par value, and then when it matures, right, it comes due at the full $1,000 par value. So, right, it's basically give them this much now, get that much back later. So no regular interest pays, all comes due all at once on one specific day, and gets paid off right at that one day. Okay, one and done. And the bond is matured, and then the bond is retired. All right. So maybe, for example, how would this work? Okay, so maybe you might buy for $600. And then it matures in 10 years at $1,000. So the investor, they'll get nothing for 9 years. And then in year 10, right, they're going to make $400, right? The difference between what they bought it for and what they got at maturity. That's the interest they earn, but they don't get it until maturity date, right? One and done. Nothing in the meanwhile. Now, why do people do that? Well, they might be good for them because maybe they don't need the cash flow right now. But what if I want to buy a boat in 5 years? So in that case, maybe I'll buy some zero coupon bonds with 5 years to maturity, right? Buy as many, right? Whatever money I have now, buy them before I can. 5 years later, they mature at $1,000 each. I get my money back and buy a boat. Okay. Let me see if I'm not sure. Let me see. Just check and see if they'll mention this. Okay, no, they don't mention it. Here's the thing. Here's the thing with the zero coupon bond. Now remember, in reality, the investor gets nothing for 9 years and then makes $400 in profits in year 10. So you might think that the investor will pay no taxes for 9 years and then pay tax on $400 in interest in year 10. You might think so, but you'd be wrong. Because the way it works is that the bonds, they're going to be taxed on basically the appreciation in value every year as it gets closer to maturity. So they're going to get $1,000 on maturity minus the $600 they paid for it. So that would be $400 in profits, but it's going to take 10 years to do it, right? So therefore, this bond is basically going to appreciate in value, increase in value at the rate of $10 per year for 10 years. I'm sorry, not $10 a year. I'm sorry, $40 a year for 10 years. So this year, for example, it's going to be in 2023, it's going to be, start off at $600. Next year, it's going to be $640. Next year, it's going to be $680. And the next year, it's going to be $720, and so on and so on. So investors are taxed as if they received $40 a year over 10 years, when in reality they got nothing for 9 years and got $400 in year 10. So this is known as phantom income. Okay, right. Paying tax on money they didn't actually receive as if they did. So it's taxed on the appreciation value. The actual word for that, by the way, the actual word is accretion. It accretes at the rate of $40 per year for 10 years. And they're taxed on the accretion as it increases in value. Okay. Right. By the way, that's what makes zero coupon bonds a definite possibility for things like IRAs or retirement accounts. Because in an IRA retirement account, you don't pay any taxes until you take the money out, presumably years later. So this way they can still mature and grow without actually having to pay taxes on it every year. Yes, Karina?
So just to verify, so term bonds are paid, are those paid semi-annually or annually?
Semi-annually, right. Unless you're specifically told otherwise.
Oh, okay. Right. And then zero bonds are paid annually.
Zero coupon bonds? No, zero coupon bonds only pay on the maturity date, one and done. But they pay taxes on the appreciation in value as it gets closer and closer to maturity.
Oh, okay. So it's not necessarily annually. It's just at the maturity date.
Right. That's exactly it. Okay. Yes, Jason.
Yeah. So the bond. So you buy it for $600. It's an individual bond, or can you buy 100 of them, or what?
Well, you can buy as many as you like, sure, or as many as you can afford.
At $600, okay.
Right, at $600 a piece, right.
And then in 10 years, you can sell, obviously cash out on them, right?
Yeah, you can cash out later, right? Okay, they'll mature, right? They'll come due at $1,000, so that's when the bonds mature.
Generally, how much is the $400 tax on the 10th year?
Well, it's okay. Again, unless you specified otherwise, you figure things are going to be taxed the way most things are taxed, right? You just pay your whatever tax bracket you fall into. So if you're in the 25% tax bracket, okay, you're going to pay $25 tax for every $100 in interest you get. Okay. Yes, Hannah.
Could you explain the difference between a zero coupon bond versus a savings bond?
Well, you know what? The depends on the type of savings bond, but if it's a Series EE savings bond, we haven't had the chance to talk about government securities yet, but that is also a zero coupon bond. Okay, except
Okay.
usually at much smaller amounts, right? You can start off I think $25.
Okay, perfect. I was kind of getting them a little confused in my head, so thank you.
Okay, right, and eventually it matures. It comes due and you get $50 or something like that. Did your grandparents get you the savings bonds instead of the toys that you really wanted?
Yeah, I did.
Yeah, right. Okay, okay. Yeah, apparently grandparents thought that socks and underwear were are just great Christmas presents and birthday presents. Okay. Hmm. All right. All right. Anyway, thanks for all of your questions here. All right. Now, another type of bond structure, okay, are called serial bonds. Okay. Now, a serial bond, they all have the same start date, but they mature on different dates, right? They mature serially, one after another. So, as an example, let's say the corporation wants to raise $100 million worth of bonds, right? They're going to raise a $100 million offering. So, they're going to sell or issue, let's say maybe $100 million here in 2023. But then they're going to redeem or mature, right? So the first, let's say in 2026 or something like that, okay, then the first $10 million matures, right, comes due, okay? And then in 2027, another $10 million comes due. And then in 2028, another $10 million comes due, okay? So they're basically repaying their debts here until eventually, maybe up until 2036, the final $10 million comes due, and now the whole bond issue is retired. But they go over as a series over a period of time. Okay. Now, because investors might be buying those with different maturity dates, right, when they get their money back, they'll usually have different yields, okay, or a different coupon, right? The coupon being the interest rate that it pays. So maybe this 26 that comes, the ones that comes due in 2026, maybe this will pay like 4% or something. Okay, but the ones due in 2027 maybe 4.25%, and the ones due in 2028 they might be 4.5%, and finally all the way out to 2036 here, and maybe these pay like 6.75%. Okay, anyway, I'm just kind of making up numbers, but to give you the illustration, after all, the longer that the bonds mature and the longer that investors have their money tied up, okay, well, they expect to be paid more for agreeing to tie up their money for a longer period of time and having that exposure and risk for that much more period of time. Okay. All right. Now, another, like a variation on the serial maturity. Okay. So, a serial maturity, they all have different maturity dates or different expiration dates, like boxes of cereal, which all have different maturity dates or expiration dates on them. A variation on the serial bond is called a balloon maturity. Okay, in a balloon maturity, it's kind of a combination between the serial bond and the term bond. So in a balloon maturity, some of the bonds, a small portion of the bonds, mature kind of early on, but then the majority or most of the bonds mature all at once at the end. Now here we have the example, right? Here's a 20-year, $20 million balloon maturity. So $2 million matures in 10 years, another $2 million in 15 years, and the remaining $16 million in 20 years. So the majority of the bond offering comes due all at once at the very end. That is known as a balloon maturity, right? It's like blowing up a balloon. Okay, now one that is not very common, okay, that's actually pretty rare, is a series bond. Series bonds have all different start dates, but they all have the same maturity date. So this might be something like they're doing like a huge construction project. They'll need a lot of money, but they don't need it all at once, and they don't want to pay interest all at once. See, if it's a term bond, they got to start paying interest right on the bonds as soon as they're sold off to investors. And if they don't need that money all at once, they're basically wasting money on interest payments that they don't need to make. So as an example, maybe like here in 2023, they'll issue like $10 million worth of bonds, and another 2024, they'll issue another $10 million in bonds, and in 2025, another $10 million in bonds, and so on, until 2033, where all $100 million of bonds mature. And they pay off all their debts, $100 million in debts, all at once in 2033. Okay. All right, so that might be one way. That's another way they can do it. Okay, series bonds are not very common. Most corporations will do term bonds, and government bonds do term bonds. Municipal bonds, which are state and local governments, they more likely use serial bonds. Okay, we'll have the chance to talk about those distinctions too. Okay, all right, bond prices and quotes. I think I just kind of reviewed this with you here. Okay, so a bond quote, as I said, percentage of its par value. As it says here, a $1,000 bond, if the price quote is 80, that's just a shorthand way of saying 80% of its par value. 80% of $1,000 is, okay, you can do 0.8 times 1,000 is $800. Now, they also say they're quoted in points. So they might be quoted as 80 points. Well, 1 point represents 1% of its $1,000 value. Well, 1% of $1,000 is $10. So if a bond goes from, let's say, its price goes from 80 to 81, it's just gone up by 1 point, or $10, from $800 to $810. All right. Now, since this bond is quoted for at 80, right? Okay, which means 80%, less than 100% of its value. So this would be known as a discount bond, right? It's trading at a discount to its par value, less than $1,000, or less than 100%. Now, if you see a price go like 110, which again is shorthand way of saying 110% of par value, again, erase the percent sign and move the decimal one to the right, that would give you $1,100. Now, this is for trading for more than $1,000. This would be called a premium bond. Okay, so like a discount bond is like what do you call merchandise for sale below its list price, right? It's on the discount rack. A premium bond means you pay more for it, like premium gas, you pay more for it. Okay, so I thought I heard something chime. Did someone like raise a hand or something? Okay. No? All right, all good then. Okay. Okay.
I have one question.
Oh yeah, please.
Can you explain really quickly one more time what you meant by discount bond and premium bond, and how you understood that the difference between those two from the examples?
Absolutely, yes. Okay. A discount bond means it's trading for less than its $1,000 par value, right, at a discounted price. Or like the price quote is 80, well, that's less, right? Which is 80%, which is less than 100%. So therefore, the price has gone down below its $1,000 value. So that's what we note as a discount bond. If the price has gone up, however, right, to $1,100, right, more than its $1,000 par value, right, or it's 110% of par value, well, that means its price is more than $1,000. That would be known as a premium bond. Okay. Oh, and by the way, if the bond is quoted at exactly 100, right, at 100 exactly, right, which means 100% of the $1,000 value, which means $1,000. This would be known as a par bond because it's trading at par. Okay, does that help answer your question?
Yes. So pretty much, the reason why you say 1,000 versus 100 is that you add a 0 at the end, just going forward with.
It'd be a little more precise to say that if I take the price quote and I move the decimal point one place to the right.
Oh,
and
I see.
The reason I say that is because maybe it's a fraction of a percentage point. So if it's a fraction, yeah, then I want to just move the decimal. So yeah, I can say I can add a 0, but it's a little more accurate to say I move the decimal one to the right. Okay. All right. So I mentioned before, corporate bonds are quoted as a percentage, right, in 1/8 of a percentage point. So 1/8 of a percent, okay, which is right. Well, what's 1/8 of $10 is $1.25. Right. So if the bond quote is quoted at 98 1/8, like we mentioned before, 98 1/8 is also 98.125 in decimal format. So now that you see it in decimal format of 98.125, move the decimal one place to the right, and you get $981.25. So that would be the cost of this bond. Now, would this be a discount bond, par bond, or premium bond? Discount, right? Less than $1,000. Conversely, here we have a bond quoted at 102 1/4, a shorthand for 102 1/4% of $1,000. Take the 1/4, convert it to decimal format, 1/4, 1 divided by 4 is 0.25. So the quote is 102.25. Now move the decimal one place to the right, and I get $1,022.50. Okay, so that's all you got to do to convert the number you see into actual dollars and cents. So my test question might ask you something like, all right, investor buys 5 bonds at 102.25. Well, then we're just going to figure, we're going to take the $1,022.50, just move the point to the right, okay, times 5. And so their total purchase, okay, now this is where I'm going to use my calculator. I'm going to take 1,022.5 times 5. And so it's a grand, right? The purchase is $5,102.50. Okay. Okay. Oh, yeah. Just as simple as that, right? Okay. All right. Now, when it comes to treasury bonds, when they say treasury bonds, that means it refers to the United States Treasury Department. And the Treasury Department is like the checkbook for the United States government. So treasury bonds is another way of saying U.S. government bonds. All right, now U.S. government bonds, there's a much bigger market for government bonds than there is for corporate bonds. And corporate bonds is a big enough market, but treasury securities, huge. Well, first off, you know how much money the Treasury Department borrows. But they're always in high demand. Why? Because they're super safe, right? Government guaranteed. And therefore, that always makes them high demand, and therefore there's always there's a bigger marketplace for them. But because there's a bigger market for them, well, they have to start drawing now finer distinctions, right? So corporate bonds, they seem to be fine in trading in 1/8 of a percentage point. Treasury bonds, however, need a finer distinction. They are quoted in 1/30, right, a 32nd of a percentage point. Okay, right. Amy says they're easily accessible too, right? Exactly. Okay, a 32nd of a percentage point. All right, now here's the way it works with treasury bonds. It's just understood that the bond price is quoted in in percentage points of fractions of a 32nd. So whatever we see to the right of a punctuation mark is just understood that's how many fractions of a 32nd. Now here our quote is 98:01. Okay, we understood whatever, okay, the 98 represents 98%, 98 points, and 1/32nd of a percentage point. So therefore, right, so the 98:01 is just understood that means 98 and 1/32nd percentage of par value of $1,000. So how do we do this now? We're going to convert fraction into decimal. All right, I know it's going to be a little more involved because there's obviously more numbers here. 1/32nd is 0.03125. Okay, so then the price quote is 98.03125 in decimal format. Now move the decimal point one place to the right, and it's $980.31.25. Now, do they really trade in 1/4 of a cent? Do you have to cut a penny up into pieces? All right. In reality, of course, you'll round off to the nearest penny. But so far, that's how you'll do it. Okay, is $981 and 31.25 cents. Here the price quote is 102:24, or 102.24. And so we understand, first off, we understand that this is a premium bond. It's more than 100%, at 102.24 of a percentage point. Okay, now this one might be a little easier to work out here, 24/32. Okay, so again, convert fraction into decimal. Get your calculator. 24 divided by 32 is 0.75. So now the price quote in decimal format is 102.75. Move the decimal point one place to the right, and you get $1,027.50. So it's just the same, right? It just takes an extra step. Now, by the way, depending on where some people quote them, let me see if I can find it here. Okay, so, all right. Depending on maybe the newspaper in which it's published or whatever data feed they get information from, they might use different formatting. In some cases, it might be like this, more like Let me put it over here. Okay, it might be 102-24 or 102.24. Okay. This 98 and 1/32, right? Some places might have it 98:01 or maybe 98:1 or 98-1 or 98-01 or 98.01 or 01. Okay, here's the thing to watch out for. See, if they give it to you in this, what looks like a decimal format, is not really a decimal. 98.01 is not 98.01% of par. It's 98 and 1/132nd percentage of par. So the test question, so one of your false answer choices might be, because you see, if you read that in decimal format, you might think it means $980.10. And it wouldn't surprise me if that was one of your false answer choices. Right? They'll set the trap. Okay? In case you didn't notice or you forgot the way treasury bonds are quoted as opposed to the way corporate bonds are quoted. Yes, Alexis.
So at the top, you did 98:01 and then 98:1.
Yes.
How is it the same way because there's not a zero after the one? So it's 98:10 would be 10/32.
That's correct. If you saw 98 and colons 10, you're correct. It would be 10/32.
Okay. So it's not like a percentage where, it's 0.1 and it's tenths of a second type of thing.
Yeah.
Okay.
Yes. It's just understood. Whenever you see the right
Thank you.
decimal point, yeah, just understood. That's just
Okay.
so everyone understands. Yes, Karina.
Just trying to reiterate what she said. So there's no difference from 98:01 versus 98:1, or
correct.
is there?
That's correct. There's no difference between them. Right.
Is there? Well, then how would it be 10/32? Like, what would it look like?
Okay. If it was 98 and 10/32, then it would look like this. Well, depends how they do it. Okay. It would either be 98.10 or 98-10 or 98:10. Okay. Well, we just understand. But yeah, right. Not because 98:1 is 98 and 1/32. 98:10 is 98 and 10/32.
I see. Okay, that makes sense.
Yes. Okay. I know it's a little confusing to start, right? But it's just the way the industry works. So it's just, hey, that's just how everyone got used to it. So, all right. Let's see. Okay. Now here. Okay. Now when it comes to getting a price quote, now every time you get a price quote, you always get two prices. You get two numbers, because bonds, for the most part, bonds are bought in a dealer market, right? They're bought and sold by dealers, which is the over-the-counter market. It's a decentralized dealer-based market. So there are dealers in securities that buy and sell, right? So, and as a dealer, right, they buy at one price and sell at a different price. And the difference between those two prices, that's the profit that they make. Kind of like how a car dealer, right? Okay, they'll buy a car from you at one price and sell it to somebody else at a different price. Okay. All right, so they are buying and selling as dealers out of inventory. So you always get two prices. You get a bid price and you get an ask price. The bid price represents the highest price that anybody out there is willing to pay for it right now at this particular moment. The ask price represents the lowest price that anyone out there is willing to sell it for at this particular moment. So when an investor places a buy order, the price they pay is the ask price, right? They'll pay what someone's asking for it. When an investor, a customer, places a sell order, they'll sell at the bid price because they're selling to the highest bidder. Now, of course, the dealer who's on the other side of the trade here, right? Well, they buy at the bid price and they sell at the ask price. And again, as an analogy, but think if you go to a car dealer and you see a sticker on the window. Well, that sticker on the window is the ask price, the price you'll buy it for and the dealer will sell it to you for. Okay. The difference between two prices is known as a spread. All right, so here's our question, like it says on the screen here. A customer sold their January 23 Treasury note. What will the customer receive? So first off, here's the January 23 Treasury note. They're going to sell it. So what price are they selling? Are they selling at the bid price or the ask price? This, Alexis, you're right. They're going to sell at the bid price. What's the bid? 99:24, 99.24, which is 99 and 24 30-seconds percentage of par. And let me get my calculator. 99 divided by 32. Oh, sorry, not 99. Okay, 24 divided by 32 is 0.75. So in decimal format, 99.75. Now that we see it in decimal format, move the decimal one to the right, $997.50. All right, so if they want to sell their Treasury note now, that January 23 Treasury note, this dealer will give them $997.50. Okay, before we move on, let me just make sure, check for anybody have any questions about that. If anything is not 100% clear, all right, please feel free to ask. Like I said, what if there's someone who's buying this January 25 Treasury bond? Well, if they're buying, what price do they pay? They pay the ask price, 96.14. Okay, 96 and 14%, 14 30-seconds of a percent. All right, so before we move on, though, we're at the top of the hour right now. Let's go ahead and take a little quick break. Okay, let's break right now and return at 13 past the hour. Okay, now if during our break, I always say that, right? If during the break, if you have a question or if you'd like me to go back to an earlier slide, please unmute or send a text here. Okay, am I back live again?
Yeah, kind of froze for a little bit.
Okay, yeah, okay. That was just the moment that the thing said, oh, I need to shut off the Wi-Fi. Okay. So it does that, it drops Wi-Fi sometimes. Okay, but thing pops up to tell me about it. So, okay. All right. So again, anything else before we go? All right, before we take our break. All right. So please feel free if you have a question, unmute and ask, or just send me a text here in the chat, and if you do, I'll reply to you in text. All right. Other than that, see you in a few. Okay.
If we were just to do, like
okay.
ask of June.
All right.
Yeah.
Okay. So let's take a look at this January 25 Treasury bond here. Okay. And the ask price. Okay. If someone's going to buy it, what price do they pay?
The 96.14, right?
96.14, correct. Okay, so let me put this on here. Let me put this on here. So they'll pay 96:14 or -14 or period 14. All right, which again means 96 and 14 30-seconds percent of par. All right. So now that we see it in fractional format, can you tell me what that would be in decimal form?
0.4375.
0.4375, right, that's what I got. So it's 96.4375. Now that we see this in decimal format, what do we do next?
Move the decimal one to the right.
Okay, which gives us
$964 and 0.375.
Yes, it is. Right.
Okay.
Okay. Now, of course, you probably have to round up to the nearest penny, so we'll call it $964.38.
Okay. I forgot to put the 96 in front after converting it, so that clears it up for me. Thank you.
That'll mix you up. Okay. All right, great. Hey, see you in a few minutes.
Thank you.
All right, and welcome back from break. Okay. Now, if I can be sure that I am welcoming back and I haven't lost my connection again, just a quick hello or something, or send me a line. Okay, thank you, Jason. Thank you, Karina.
Hello.
Hello. Okay. Thank you, Ashley. All right, I'm going to take that also as a good sign. Okay, it's a good positive sign. Okay, let me just set up everything here. Okay, all right, let's continue our discussion here about bonds and their prices and spreads. Okay, thank you, Hannah. Okay, I am recording. Okay, good. Okay. All right, so again, the bond quote, okay, so bond quotes now, sometimes bonds are not priced as a dollar amount or as a percentage of par. Instead, they're priced as their yield. Yield is a way to measure, is the measurement of the return on investment. Okay, that's what's go right, is return on investment. And that's measured as a percentage. Now, the term bonds, right, they're quoted as dollar amounts because they all have the same start and stop date, right? They all have the same interest payment. But serial bonds, right? They have different maturities, so they also have different interest rates. So instead, they're quoted based on their yield rather than on a dollar price. Now, the typical payment is on basis points. A basis point is equal to, same as, equals 1/100th of a percentage point, 1/100th of a percent, or 0.01%. So that's the main. See, a basis point is the minimum possible increment when we're talking about changes or moves in interest rates, okay, or in yields or in rate of return. So a basis point is 1/100th of a percentage point, which also means that 100 basis points or bips, okay, is the same as 1%, 1 percentage point. Okay, so if you hear on the news, right, they say, well, is the Fed going to change interest rates today? Or they changed interest rates by 25 basis points. Well, 25 basis points is 25/100ths, and 25/100ths is the same as 1/4. So it's right, 1/4 of a percentage point. It's also the same as 25 basis points. Okay, so a basis point is 1/100th of a percent. Okay, right now, by the way, since a bond is a $1,000 bond, a $1,000 face value, and 1/100th of 1% of that is how much, right? Well, remember we said 1% is $10. 1/100% of that is, right, 10 cents. So every basis point is 10 cents. So a bond yielding, like it says, bond yielding 5.01 to 5.02, 1 basis point. Bond yielding 5.1%, now it's yielding 5.2%. That's the rate of return it pays, 10 basis points. And the bond yielding 5% to 6%, 100 basis points. Okay, now I'll give you more like a practical example of that, but I took advantage, right, in COVID world, when interest rates dropped to next to nothing, took advantage, okay, of lower interest rates, and I refinanced my mortgage. And so my mortgage rate went from 4.5% to 3.25%. How many basis points did I just reduce my mortgage? Can anyone tell me?
$1.25.
It's 1.25 percentage points, yes. But how many basis points would that be if you understand that, right? 1 percentage point is the same as 100 basis points. A little more than 1, Amy. Okay, it was 1.25 percentage points, and there's 100 basis points in a percentage point. 125, you got it, Mike. Okay, and it sounds a lot better, doesn't it, to say I saved 125 basis points rather than I said 1.25 percentage points? It sounds a little better, doesn't it? Means the same thing, it just sounds better. Okay. All right, here's our next section here, which is how the effect of interest rates on movement on bond prices and yields. Now, because people have asked me, we've talked about how bond prices move up and down, right? We've seen some quotes, right? If the price goes down, it's called, but less than $1,000, it's called a discount bond. If it's trading for more than $1,000, it's called a premium bond. Well, people have asked me, why do bond prices move at all? You're supposed to get your $1,000 back when the bond matures, right? So why do bonds ever change their price? Yes, Jason?
And I was just wondering, can you backtrack to that last slide? I just wanted to, yeah. It's okay.
Okay.
You're good.
Okay.
Thank you.
So here's the thing, right? So just again, the way that a serial bond might be quoted is not in dollars and cents, but in yield. So, for example, they've got all these bonds, right? All that in a serial bond with different maturity dates. So the bonds that come due in 2025, maybe they're yielding 5.25%, and the bonds maturing the following year, maybe they're 5.3%, and the bonds after that they're yielding 5.4%. So rather than give you their price, they're telling you their rate of return. Okay, I thought I heard a ding. Did someone have a question? Okay, all good if you don't, so that's no problem. All right, so here, why do bond prices change at all? Well, because think about when you buy a bond, what are you buying, right? You're buying an income stream, right? These interest payments are supposed to go out regularly, and a promise to pay. So anything that affects those two things will affect the market price of a bond. And mostly it's going to be in response to changes in interest rates. When you hear about changes in interest rates, that's probably the biggest factor in the price of a bond. So we want to understand, first off, there's an inverse relationship between a bond price and a bond yield. Inverse means opposite, right? They go in opposite directions. So if interest rates go up, what happens to the price of bonds? They go down. And if interest rates go down, right, what happens to the market price of bonds? They go up. Right? Well, if you know, interest rates have been going up lately, right, as the Federal Reserve has tightened credit. So the interest rates have been going up. What's been the effect on the price of bonds? The market price of bonds go down. We say, well, why is that? Let's say you've got a 6% bond. It pays 6% interest on a $1,000 loan, which it pays $60 a year. And it's locked in. It pays $60 a year for the life of the bond. That doesn't change. But what if interest rates have gone up since that bond was issued? What if new bonds come now, pay 7%, $70 a year? It's not hard to figure out which one you'd rather have, right? So what if you own a 6% bond, it's locked in paying $60 a year for the life of the bond? Well, what if you want to sell the bond before it matures? How are you going to convince someone to buy it from you? Right? If they can get a bond someplace else that pays 7%. Well, the only way you can convince them is you'd have to drop the price. And you have to drop it to such a degree that on the $60 a year that they're making, they're still getting like a 7% return on their money. Right? So because right to make it competitive. So that's why if interest rates go up, bond prices go down. Second question is, so would now be a good time to buy bonds? Well, what do we think about what's likely to happen for interest rates going forward? What have we heard on the news? Maybe we've heard maybe that the Fed might slow down. It's ratcheting up its interest rates, but they'll still keep their options open. Yeah, okay. Most likely to stay high, at least like for the time being. So maybe this is not the worst time at all to buy bonds. Okay. All right. On the other hand, let's say you've got a 6% bond, pays $60 a year, but interest rates have gone down since that bond was issued. New bonds coming out now pay 5%, $50 a year. In which case, your $60 a year bond looks pretty good by comparison, doesn't it? So therefore, if you wanted to sell it, it's worth something, isn't it? Because you can get, right, they buy your bond for 6%, right, $60 a year, and then $50 a year. So it's worth something more to them to pay and get $60 a year. So that's why the price goes up. So mostly, so if interest rates go up, right, bond prices go down and they start becoming discount bonds. And of course, if the interest rates go down, bond prices go up and they start becoming premium bonds. Okay, all good? Okay, this is a really important concept, right? This inverse relationship between prices and yields. And I hope to illustrate as to why that's the case. Now, when you buy, of course, you're going to get some return on your investment, okay? And your return on your investment is your yield, right? Your rate of return, as I mentioned before, it's measured as a percentage, all right? And it's basically a ratio of the income that the bond pays, the interest that it pays, over a year's time versus the price. Yes, Kimberly?
I thought that bond rates were inverse to what the interest rates are doing. So wouldn't it not be a good time to buy bonds? Unless, I mean, I know corporate, like, are corporate bonds different than treasury bonds as far as the rate?
Well, the interest, are you talking about the interest rate that it pays?
Yeah.
Okay. Well, we'll get into further distinctions, of course. Now we're kind of like talking about bonds overall. We'll start drawing finer distinctions too. But corporate bonds issued by corporations have some more risk to them. Because if that corporation If their business isn't doing so great, they may have a harder time paying their interest payments, right? Making those interest payments, paying their debts. So a corporate bond having more risk is going to have a higher rate of return, a higher nominal yield or an interest rate than a government bond. Government bonds have a very low rate because.
So I guess the part I'm confused on is I thought the interest paid on bonds goes down if interest rates go up.
Oh, that's correct. Well, no, the price.
So if the interest rates are
price-
going up, then you wouldn't, right? It wouldn't be a good time to buy bonds, right? Even if you're getting them at discount, you're not going to get the better interest.
Well, let's put it this way, right? If the interest rates have gone up, in fact, I think I'll be able to illustrate this here, but interest rates have gone up quite significantly, right? Okay, but of course they went down to rock bottom just before that. So, okay, all right. So when the interest rates went down, of course, right, a couple years ago, of course, bond prices went up, right? The price of the bond went up. Well, now that interest rates have gone up, well, the market price of bonds have gone down since then. So would this be a good time to buy? Well, certainly they're a lower price than they were a couple years ago. You can say that for sure. Would it be a good time now? Well, we'll kind of have to judge what you think about how likely it is interest rates stay the same and don't go up anymore.
So bonds that you might have already owned in your portfolio are not going to do well when the interest rates go up if you've owned them for a while.
Yeah, the market price would go down. Yeah, if interest rates go up. If you own a bond, you wanted to sell it before it matures, you're going to have to drop the price if you want to sell it.
Okay.
And quite possibly you won't be able to sell for what you paid for it. Now, of course, if someone plans on holding to the bond until maturity, they may be entirely indifferent as to what market price the bonds are doing. They don't care because they just plan on buying and holding.
Okay, thank you.
Sure thing, you bet. Okay. So if you think of the yield as their rate of return, right, their return on their investment as a percentage. But there's a few ways of looking at it, so that's why there's a few types of yields. Now, the most basic one is the one we talked about, the nominal yield. Nominal means name, is the named interest rate. Also called the stated interest rate, also called the coupon, named after all the tear-off coupons that they used to have. Now, the nominal yield is set when the bond is created. That's the interest rate that it pays on a $1,000 loan, and it does not change over the life of the bond. It is locked in permanently. It will never change. Okay. And it says, write this like it says, a 5% bond, 5% of $1,000 is its nominal yield. It pays $50 a year. That's why knowing the nominal yield is helpful. You know how much the bondholder collects in interest every year. 5% pays $50 a year. Now, while the nominal yield, the named interest rate, is fixed and does not change, what does change is the current yield, because the current yield is return on investment based on the current price. So if the current price changes, then the current yield changes. Because that's going to be, okay, how much you're making as a rate of return based on the price. Or, of course, it may be on the purchase price if somebody already bought the bond. Okay, so to figure out the current yield, what we're going to take is the annual interest payment. And you know the annual interest payment when you know the nominal yield. And you're going to divide that by the bond's current price. Okay, so let's say we've got a 5% bond trading at $800. So first off, a 5% bond pays 5% interest on a $1,000 loan, $50 a year. Remember, move the decimal one place to the right. So $50 a year divided by the $800 purchase price. Well, if you crunch that in your calculator, well, what you'll see is, right, 0.0625. Well, now that you see it in decimal format, now move the decimal 2 places to the right to get it in percentage format. It would be 6.25% would be the current yield. Right? Someone's getting $50 a year on an $800 investment is a 6.25% return on their money. Notice what happened. The price went down from $1,000 to $800. It's a discount bond. And when that happened, the yield went from 5%, right? Went from 5% to 6.25%. The price went down and the current yield went up. It's an inverse relationship. The same thing would happen, though, if it was a premium bond. We have a 5% bond, but now its market price is $1,200. So they're still going to receive $50 a year, but they're getting it on a $1,200 investment. Crunch that in your calculator, 50 divided by 1,200, and you get 0.0417, right, rounded off. Okay, which of course would be the same as 4.17%. So that's the return they're getting on their money when they had to pay when they're getting $50 a year on a $1,200 investment. Notice that when the price went up from $1,000 to $1,200, the yield went down from 5% to 4.17%. Inverse relationship. So when people ask me, well, which formula should I learn for the test? Well, it's hard to predict what you'll see. It's not that much of a math test overall, but you'll need some, right? There'll be some questions you'll need a calculator. But I would suggest the current yield first. Remember we talked about this before on Monday when we talked about dividends, when stocks pay dividends? What was they called it then, right? The same formula, just had a different name. Then it was called a dividend yield instead. It was still the annual interest, or sorry, the annual dividends that it pays, right, over the course of a year, divided by the current price. Right. So same formula, they just give it a different name as dividend yield. When it's a bond, it's a current yield. Now, another way of looking at the bond's yield is the yield to maturity, or YTM. Right. Yield to maturity is the return on investment, but in this case, it assumes that the bond is going to be held all the way to the maturity date. Because when the bond matures, that's the day the loan comes due and the bond is retired, and the bondholder gets the $1,000 par value back. Right? Bond issuer is going to repay them their $1,000. But what if somebody bought the bond for a discount? What if they bought it for less than $1,000? Well, they bought it for $950 or something like that. When the bond matures, they're going to get $1,000. That's an extra $50. It's like a bonus for holding it all the way to maturity. So if they're going to get more money, what would that do to their yield, which is their return on their investment? Would getting more money increase their yield or decrease their yield? What do you think? Okay, Amy says a plus sign. Okay, which I think you mean increase. I agree. Yes, more money, higher yield. So what happens then, if the price goes down, the nominal yield stays the same because it's always the same. The current yield goes up because it's because they bought it at a lower price, and the yield to maturity goes up more than that for the difference between what they bought the bond for and what they got on the bond's maturity date. Right. So the yield to maturity is going to be greater than the current yield if the bond's trading at a discount. On the other hand, the exact opposite happens on a premium bond. If the price has gone up, it's above par value, the price goes up, the nominal yield stays the same because it's always the same. The current yield goes down because they had to pay a higher price for the bond, and the yield to maturity goes down more than that, right? Because if they bought the bond at a premium, let's say $1,050, but they'll get $1,000 when it matures. Well, that's a built-in loss of $50 for holding it to maturity. Okay, so that's why they get less money for it, and therefore their yield goes down. Okay, yes, Karina.
Then why would one invest in a premium bond when they are not going to be gaining money from it?
Makes you wonder, doesn't it? Okay, why would somebody be willing to pay more money for it? Remember, why is the bond trading at a premium? Why did the price go up? The price goes up when interest rates go down. So this bond has a higher nominal yield or a higher coupon than they could get otherwise, right? It's a 6% bond, but now bonds pay 5%. So it's worth it to them to pay more for the bond because every 6 months when they collect their interest payment, they're going to get more money as a result of it. So it's worth it to them to pay more for it because they're going to get a higher payment, a bigger check every 6 months. Oh, okay. Oh, someone's coming in here. Okay. Okay. Janie, I think you has just joined us here. Okay.
Yeah.
Okay. All right. Glad to see you. Okay. Well, we're in the middle of discussion on bonds here, so we kind of picked up some stuff here before, as we went on before. But I think hopefully we'll be able to pick up here. And again, if something's unclear, please feel free to unmute and please ask questions if you need. Okay, now there is a formula to calculate the yield to maturity. It starts with the current yield formula, but then adds some extra steps to it. And on paper, it looks a little intimidating. But when you break it down to what it's really saying, it kind of falls into place. Let me see if there's any talked about it here. Okay. All right, so this is here all right, again, the discount bond, the yield to maturity, right, is the coupon plus, right, the discount they paid for it, right, and what they get when they receive at maturity. And they're using the example, right, a $1,000 bond was purchased at $900, 10 years to maturity. So the customer's going to receive another $100, right, because when they bought it for $900, they'll get $1,000. So that's why their yield to maturity increases, because the price has gone down. Again, the other concept is the premium bond, the price went up, bought the bond for $1,100 in 10 years to maturity, but nevertheless, they're going to get $1,000 when it matures. Okay, so again, it's more, right, the test isn't so much that you can do the math on it. They're more concerned that you understand the relationship between how the price of bonds and changes in interest rates and the different types of yields, their relative changes. As I said, there is a formula for it. I could even walk you through the formula if you like, but like I said, you probably don't need it. Okay, here's the basics of it, though. If you think about the bond's total return, right, everything you get from it. So let's say the bond purchased at, okay, here we go, $900 with 10 years to maturity. First off, it's a 10% bond. Pays $100 a year in interest, right? Okay, so first off, the bondholder is going to collect $100 a year in interest. But since the bond was bought for $900, but they'll get $1,000 when it matures, right? So we're going to take that $1,000 they get minus what they bought for it. Okay, so that's again another $100. But it's going to take 10 years to get there, right? 10 years to mature. So they'll get their $100, but it's going to take 10 years. So figure that this bond is basically going to increase in value, right? Make $100 over 10 years time, and will increase in value at the rate of $10 per year for the next 10 years. So if you think that their total, let's say, benefit from this is the $100 in interest payments plus the $10 in annual accretion or increase in value, so their total value is actually $110 per year. Okay. Now, what do you divide that by? See, previously in the other formula, you divide by the current price. In the yield to maturity formula, because remember, what do they get when it matures, right? They get $1,000 back. So what we're going to do is we're going to take the average of what they paid on maturity. Okay, what they paid on maturity. Let me fix this here. I'm going to bring this over down. Okay, because I'm running out of room to type here. Okay, so we're going to take the average of what they paid for the bond and what they get on maturity. Now you know how to figure out the average of something, right? You add the two numbers together, divide by 2. So we're going to take the $900 purchase price, add to that the $1,000 they get when it matures, which is $1,900, and divide the result by 2. So what's the average of that is $950. Okay, so that's going to be the denominator. So now our formula becomes the $110 in annual benefit divided by the average of the purchase price and the maturity price, what they get on maturity, and that's going to be now their yield to maturity. Grab my calculator. Okay, grab my calculator, and I'm going to take 110 divide by 950, and I'm going to get about 0.1158 or 11.58%. You'll round it off to 1 or 2 decimal places. Okay, so that's kind of how it works. So the nominal yield was 10%. The current and the yield to maturity is about 11.5% roughly. Okay, like I said, you probably don't need the formula, so I wouldn't sweat it too much, but it's there just in case. Okay, so how does a question going to present itself? How would a question present itself? Okay, something like investor buys a 6% bond, okay, at 95, okay, and matures in 10 years. Okay, what is the yield to maturity? Okay, rather than go to the formula, so our 4 answer choice would be something like A, 5.7%, B, 6%, C, 6.3%, or D, 6.7%. 6.7%. Okay. Now, first off, we know that this is a discount bond, right? It's trading at 95. The price has gone down. If the price has gone down, okay, that means the yield has gone up. Now, the nominal yield is 6%. It must be more than that. So we've just eliminated A and B. We can crush the numbers and work out the current yield formula, right? 6% bond, $60 a year, divided by a $950 price. That works out to about 6.3%. The yield to maturity must be more than the current yield. Well, there's only one answer choice that matches what we're looking for, 6.7%. See, with the process of elimination, you can sometimes figure out the answer without figuring out the answer. Okay. So that's likely the way the test will show up. Okay. All right. Now, the best way to visualize the relationship between the price of bonds and yields is this. It's a seesaw diagram. Okay, very, very helpful tool. It just gives you a good visualization about how the change in price affects the different yields. So if the price has gone down, right, if it's a discount bond, let me draw this here, price has gone down, okay, now the nominal yield, which is like the center, the fulcrum of the seesaw, the part in the middle that never moves. So the nominal yield stays the same. The current yield, however, if the price has gone down, the current yield goes up, and the yield to maturity, which is when the bond is held all the way to the end, like the end of the seesaw, goes up even more. So this is a great visualization, a great visual reference here. Of course, if the bond is trading at a premium, well, then the exact opposite happens. If the price has gone up, the nominal yield, the named interest rate, the center of the seesaw, does not change. It doesn't move. The current yield goes down, and the yield to maturity, when the bond is held all the way to the end, like the end of the seesaw, goes down even more. Okay. Anyway, it's just a very helpful tool. And here we have a par bond. That means the bond is trading at $1,000 exactly. Well, in that case, the price has not gone up or down, and therefore the yield has not gone up or down. And the nominal yield, current yield, and yield to maturity are all the same. Okay, so if the bond, so here again, if the bond is priced at par, all the yields are the same. If the price is at discount, right, the nominal yield stays the same, the current yield goes up, the yield to maturity goes up more than that. And of course, if the price has gone up, it's a premium bond, nominal yield still stays the same, current yield goes down, yield to maturity goes down even more than that. All right, I'm going to add one more to this, right, because I don't see it on the slide, but there's another yield which is called yield to call, YTC. This is the case where a bond is callable. That means that the bond issuer, right, the corporation, for example, has the right to cash out investors prematurely, to call their bonds away from them and give them their $1,000 back. This is non-voluntary, by the way. So the yield to call is basically the return on investment, but now it assumes that the bond is in fact called away at the earliest possible date. Investors might want to know that, by the way, because they'll say, well, what if it does get called back early? What's my rate of return? The yield to call ends up being the most volatile yield of all. Okay, the most up and down. See, the nominal yield never changes. Current yield goes up and down, but the yield to maturity goes up even more, and the yield to call goes up and down even more than that. So if the price goes down, right, the yield to call goes up the most, and if it's a premium bond where the price has gone up, then the yield to call goes down the most. And the reason why? It accelerates the whole process. It speeds it all up. Instead of having to wait 10 years to get their money back, maybe they get it back in 5. Okay, so since it speeds it up, the yield to call ends up being more volatile, bigger up and down than any other of the other yields. Okay, I'll mention that. Hey, you never know what they'll ask you, right? So in case it comes up. Okay, are you good with this part? Any part that still feels a little fuzzy? This is one of the most important concepts here. Hang on a second. What I'm trying to do here, see if I'm looking to see if I've got a prop for you, and I don't. All right. Okay. What I was going to do, let me see if I got one with me though. Here we go. Instead of drawing a seesaw on my scratch paper. By the way, if you draw a seesaw, you just saw something like oops, I didn't want to do that. I hate when that happens. Where we go? Okay, back. Here we go. This is where it was. So you probably draw it a lot like this. Okay, you just draw like a seesaw, kind of like this. Okay, just draw this on your scratch paper, right? This triangle and a plank that represents the seesaw, right? So you go up and down from there. Okay. Rather than use that, here's what I do. I like to use my pen. And I just grip it in the center between my thumb and forefinger, right in the middle, to represent like the fulcrum of the seesaw, right in the middle, with the button end on the left and the pointed end on the right. So if the test section says that bond is a premium bond, the price has gone up. If the price has gone up, the nominal yield in the middle stays the same, the current yield goes down, and the yield to maturity when it's held all the way to the end goes down more than that. Yield to call goes down more than that. Or if the test question says the bond's it's a discount bond, the price has gone down. If the price went down, the nominal yield stays the same, the current yield goes up, the yield to maturity when it's held to the end goes up more, and yield to call goes up more than that. All right, should they ask about that? Anyway, because this becomes now like a visual tactile reference, right? Something I can see and touch. Or here's another way. The test question says interest rates have been rising. If interest rates on this side goes up, what happens to the price? The price goes down. Or interest rates have been falling. If interest rates go down, what happens to the market price of bonds? Goes up. Okay, anyway, it's a great visualization. Please use that whether you draw it on your scratch paper or use your pen like that. It's just a very helpful tool. Yeah, I still use it a lot. All right, are you okay? Let's see if there's anything else here. All right, okay. Tell you what, we're actually this close. I might have waited a couple more minutes here, but we're okay. Okay. Now, do you feel like taking a break just yet, or do you want to wait until like the top of the hour? Is your brain full? Okay, Ash would like to wait. Anyone else? Colby too? Okay, and Alexis and Hannah. All right, all good. Then let's start now talking about, we're going to go a little bit deeper now into bonds by talking about some of the more features of bonds and the risks of bonds. Okay, because we talked about their benefits, right? You get us, you're supposed to get a rate of return and interest rate paid twice a year. Okay, that's how your money makes money. All right, so we're going to talk about now bonds with call and put features. Well, I just mentioned the call feature a little bit here. So the bond is callable. The issuer, right, the corporation, can call the bond away, right, basically prematurely, right, before its maturity date and retire the bond early, give investors their money back, and cancel out the bonds. Okay, as I said, it's non-voluntary, so investors don't have a choice about it. Okay, so they might have to offer to cash them out early. All right, so callable bonds. Now, again, why would a corporation, right, want to call its bonds away, right, and cash out investors? Well, maybe they want to get debt off their books, but the reason they're more likely to do so is if interest rates have gone down since that bond was issued. Well, now they can cash out these old bonds with a high interest rate and issue new bonds at a lower interest rate and save a whole lot of money on interest. It's like refinancing their mortgage, right? Okay, so from the investor's point of view, however, having their bond called away from them, from the investor's point of view, do you think that's a good thing or a bad thing from the investor's perspective? What do you think? Kimberly says bad. So does Alexis. So does Karina. Anyone else have an opinion here? Well, you know, I'm going to agree with you. Okay. From the investor's point of view, right, not a good thing. Like Amy says, it benefits the company, not the issue, not the investor. Exactly. Because the investor, they get their cashed out. They're not going to collect these interest payments that they've been receiving. All right, they'll get their money back, but now they got to invest it someplace else. Well, if interest rates have gone down since that bond was issued, and that's likely what's happened, they won't be able to reinvest it at the same rate of return they did before, right? They'd face a loss of income. So investor buying a callable bond is kind of making the bet here that interest rates aren't going to go up anymore, or aren't going to go down. Okay, well, if they don't win that bet, okay, they're going to get their bonds cashed out. But there's an extra risk, isn't there? In fact, if it's even known as call risk. So therefore, a callable bond having a higher risk to it is going to have a higher coupon, a higher interest rate than a non-callable bond, all else being equal. Always remember, right? Investors are not going to take more risk unless it's a risk worth taking. Okay. Question says it's more value to the investors, but more expensive for the company because of the higher interest. Okay. Yeah. Okay. Yeah. More value for investors. Right. Well, that's true too, right? Investors get a higher interest rate, but the company's got to pay a higher interest rate. And I don't like paying a higher interest rate either. Right? So, okay. All right. So but that's going to be the trade-off. All right. Now, notice that these bonds will not be called after a stated call date. In fact, that is known as call protection. Okay. So that means they promise that they will not call the bonds for a certain period of time. Investors are safe for at least a certain period of time. After that call protection is elapsed, okay, now they're subject to being cashed out. If they do cash out investors, though, they probably have to pay them something over and above the par value of the bond for the inconvenience of having their bonds cashed out from them. Okay, so that is called a call premium. So there might be something like, let's see, ABC Corporation, 7% bond matures, right? It comes due in, let's say, 2035, callable 2025, okay, at 102. So this little shorthand notation here, the letter M is for matures, right? That's the day the bond comes due, right, in 2035. But it's callable starting in 2025. Before that, the bond can't be called away. Investors are safe. That's their call protection. After 2025, it's now fair game. But if they do cash them out investors, what do they have to pay them? 102% of par. Who can tell me in dollars and cents what is a price quote of 102? What does that represent in dollars and cents? Oh, anyone? 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 Bueller? We did walk through this. Do you not remember?
It's at 102%, isn't it?
That's right, 102%. What does that translate to in dollars and cents? How much for the check is the bondholder going to receive?
Are those the prices 2035 and 2025, or are those the dates?
Those are the dates, right? Yeah. The maturity date, the callable date. So the investor gets a check for how much?
You get
$1,000.
Okay, well, let's see. Alexis said 1,025. Amy says par is 1,000, but remember, they're going to get a call premium over and above. Okay, Kobe said 1,060. Oh, someone said 1,020. Okay, there you go, Alexis. $1,020, right? 102% of par value. Again, move the decimal one place to the right is 1,020. Okay. All right, so remember, keep practicing these, right? Keep practicing until it's like second nature. That's the way you want to be, right? When you sit down at the desk at the test center, right? Until you've just done this so much times, right? It's on autopilot by then. That's the place you want to be by the time you get to the testing center, and then you just do it like you rehearsed it. Okay, now like we said before, right? More likely the bonds will be called if interest rates go down, and of course if there's a smaller call premium, they're more likely to want to call those in too. And therefore they can refinance by issuing new bonds at lower interest rates. That's the idea here. That's the plan. Okay, so the call protection, the how of the years before the bonds can call in the bond. And here we have an example. The bond was issued in 2023, and the bond has 10 years of call protection. So they cannot call it away from them until 2033. But as the bond gets closer to maturity, premium gets smaller, okay? So if they do cash them out as early as they can in 2033, they got to pay them 105 or $1,050. If they wait another year and cash them out at 2034, they'll just have to pay them $1,040, and so on until until 2038, when the bond's getting real close to its maturity date now. Okay, so then they'll pay them back at par value. Okay. I usually, by the way, don't see these tables like this. Usually when I see them in a test question, or at least a practice question, I see just that says it's callable at 102 or 103 or something like that. But but it is possible where the company sets it up so that as it gets closer to maturity, right, the call premium gets smaller and smaller. That's a possibility. Okay. All right, we did mention, yield to call. The slide came up a little later than I thought. But anyway, the idea again, the yield to call is the most volatile of the yields, right? It goes up the most and it goes down the most. You don't have to calculate it, just understand the relationship. And the seesaw diagram, of course, is the very best way to visualize that relationship. It's really super helpful. Okay. All right, so here we're talking about the yield to calls, again, the discount and premium bond. It's just basically reiterating what we just talked about. Okay, if the price has gone down, the nominal yield stays the same, the current yield goes up, the yield to maturity, if it's held out till, let's say, 10 years, goes up even more. But if it's called in after 5 years, it accelerates the whole process, so their yield to call would be even greater percentage than their yield to maturity. And of course, again, the exact opposite happens on a premium bond, because now they're basically, remember, there's a built-in loss to it, and so it just basically accelerates the loss, right? It's going down at a faster rate than before, so right, the yield to call, right, for a premium bond is even lower than yield to maturity. Okay, again, understand the concepts, it's understand the relationships, and here we go again. We got the seesaw diagram, or at least the way they like to draw a seesaw diagram. Okay. So with all the yields, nominal yield at the center never moves, right? The current yield goes up or down. The yield to maturity goes up or down more than that. And the yield to call goes up and down the most volatile of those yields. Nominal yield has no volatility at all, always stays the same. Okay, now some bonds, of course, are callable, but bonds might also have a put feature. And a puttable bond is one where the bond holder now has the ability to give the bond back to the issuer, right? Redeem their bond, right, prematurely before the maturity date and get their money back early. Put the bond back to the issuer and get their money back. Again, there might be, after some period of time, right, there may be put protection where they can't cash out before a certain date. Okay, but that would allow bondholders to cash out early. Now, investors want to do that if interest rates have gone up. Now they can give back this old bond with a low interest rate, get their money back, and go invest in another bond with a higher interest rate and make more money. Now, since this is a feature that benefits the investor and is a detriment to the bond issuer, well, then a puttable bond is going to have a lower coupon, a lower interest rate than a non-puttable bond, all else being equal, right? It reduces the risk to the investor, increases the risk to the issuer, so they have a lower coupon rate as a result of that. Okay, now, before we go on to our next section here about risks, and we're exactly at the top of the hour, I think it's time to take a good, well-deserved break. Okay, and let's return at 10 past the hour. Okay, and again, if you have any other questions or want to go back to an earlier slide, please go ahead, unmute or type in the chat, and I'll reply to you appropriately. All right, on that, see you in a few. Okay, so welcome back from break. All right, there was a question that came up in the chat. I'm sorry I didn't see it before, but the question was, are corporate bonds also sold at $1,000 par? In general, when people are speaking of bonds, do they mean government bonds specifically or all bonds? The answer is yes. Corporate bonds, government bonds, municipal bonds are sold at $1,000 par value. Okay, now as a little side here, but not likely to show up on the test, but you can buy government bonds for as little as basically $100. right, through treasurydirect.gov. But nevertheless, especially for the test, still have a $1,000 par value. And so if people are speaking about bonds, do they mean government bonds specifically? No, they mean bonds in general. They would have to specify what type of bond, right? Whether it's corporate or government, okay? And sometimes we may have to draw finer distinctions than that. But other than that, they'd have to specify. And if it doesn't specify, they're just speaking in general terms. Okay. Anyway, I hope that helps answer your question. Okay. All right, let's take our, okay, sure thing, Kimberly. Okay. All right, let's take our next question here. Okay. All right, bond ratings. Okay, now these are being ratings. These are for corporate bonds now. Okay, government bonds are like they're government guaranteed, so like they're extremely safe, so they always get the highest rating. But a corporation, however, well, may have its ratings may be different, right? Because think of it this way: just like you and I have a credit score, well, corporate bonds have a credit rating also. Someone's assessment as to the likelihood that they'll be able to pay their debts. Okay, so the bond rating is how we try to measure the risk of default. Default risk is also called credit risk. It's the risk that, well, you lend somebody money and they don't pay you back. Just like if you got friends who are more likely to pay you back if you lend them money than not. So if they miss interest payments or principal payments or both, right, that is default. So there are, at least for the test, there are 2 ratings agencies that we want to know about. In the real world, there are more than 2. But for now, just 2 ratings agencies, and they are Moody's and Standard & Poor's. S&P is Standard & Poor's. So they are research companies, and they basically make an assessment about how likely they think the issuer can repay its loans, and they assign a grade on them. All right, so the grade they give is, well, it's kind of like you're back in school, right? So an A grade is their best rating, but the very best rating is AAA. Then it's AA, then just single A. Now, Moody's goes BAA, where Standard & Poor's is BBB. Then it's BA or BB, then B. Moody's goes CAA, where Standard & Poor's is CCC, CA or CC, and then just C. Actually, the Standard & Poor's goes all the way down to a D rating. That's their bottommost rating, a D rating. And D is for like in default. Already defaulted on the loan with a low probability of recovery. So that's about the worst rating they can give. Okay, so well, things to notice here. First off is that any A rating is better than any B rating, right? Single A is better than triple B, right? Single B is better than triple C. Also notice that Standard & Poor's ratings are in all caps, where Moody's ratings are uppercase and lowercase. So this might help you out a little bit here. If you think of this phrase, is that mood swings are up and down. So that'll give you a reminder here that Moody's ratings are uppercase and lowercase. Now Standard & Poor's, their ratings are all caps, right? Standard & Poor's, S&P. I'm glad you like that, Kimberly. Standard & Poor's, right? There, right, is 2 capital letters. Their ratings are in all caps. Now, one thing to notice here is where's that cutoff line, which the top tier credit rating, which we call investment grade bonds, right? These are considered very safe bonds. These are the ones you get for your grandmother. And the ones that are considered, well, below investment grade, or they're considered speculative bonds. They're also called them high yield bonds. But why did they get a high yield? They have a high yield because they have a high risk. Just like if you and I have a high credit score, we get to pay a lower interest rating on our bills, right, on our debts. If we have a low credit score because someone thinks we're deadbeats, we're going to have to pay a higher interest rate, right, because we now face a higher risk. So keep that in mind when they ask you about these what would you recommend kind of questions. Everybody wants a higher yield. Not everybody wants higher risk. Or if you're not as polite about it, they call them junk bonds. So where's the cutoff line between what's considered investment grade and what's considered speculative or high yield? Well, for Standard & Poor's, right, you notice that anything triple B rated and higher is considered investment grade, right? Whereas double B and lower are considered speculative. Here's a way you can remember that. If a bond is rated triple B or higher, I figure it must be a quality company, maybe a member of the Better Business Bureau. So Better Business Bureau, BBB, reminds me that bonds rated BBB and higher are considered investment grade. Bonds BB and lower are considered speculative because BB guns are dangerous. So, okay, that might help you remember that too. BB and lower, BB guns are dangerous. Now, Moody's, right, bonds rated BAA and higher are considered investment grade. Here's the way you can remember this. Did you have a speak and say when you were a kid? Right, that's the one where I'm trying to highlight it here. So there it is. No, there. Oh, it's not the one I wanted to highlight. Let me try that again. Did you have a speak and say when you were a kid? Remember, that's the toy where you pull a string or maybe you pull a lever, and the arrow spins around. It lands on a drawing of a farm animal, and then a voice goes, "The cow says moo. The sheep says baa." Trust me, you are going to remember that for the rest of your life. Okay. All right, is that good with the? Okay, glad you like that, Karina. Okay. All right. So anyway, just something to help you to remember this. And by the way, this is like something to help you with memory. Okay. Is if you can make up some word association or some goofy, silly thing, because in fact, as ridiculous it is, right, it sticks with a little better. Okay. It's kind of the absurdity that stands out. Okay. All right. So that's the thing about bond rates. Now, of course, again, these are for corporate bonds. Government bonds, of course, are already very highly rated most of the time. Okay. Recent headlines aside. Okay. But government bonds are AAA rated. Recent headlines aside. Okay, all right? Okay, good. Okay, now here's the thing, okay? So with interest rate risk is the risk that if interest rates go up, what happens to the market price of bonds, right? The market price goes down, right? The inverse relationship. So if you wanted to sell your bond before it matured, and interest rates have gone up since then, you might not be able to sell it for as much as you paid for it. Okay. So that's the thing. Now, here's the thing also is that shorter term bonds, right, have smaller price range, they're less volatile. Longer term bonds are more volatile, right? Bigger up and down price range. And that's because, well, they're longer term. So they're locked in at paying this rate for a longer period of time. So again, let's say you own a 5% bond and interest rates have gone up since then to like 6%. So your 5% bond doesn't look as attractive, does it? So if you wanted to sell it, you'd have to basically discount the price to convince someone to buy it from you. But if the bond is going to mature, let's say in another 2 years, all right, sure, it's locked in paying a lower interest rate, but only for another couple years before someone gets their money back. So yeah, you'd have to drop the price, but not that much, right? It's not that big a deal. On the other hand, if that bond's got like 20 years until it's matured, and it's locked in paying a lower interest rate for another 20 years, that's a big deal. You'd really have to reduce the price, really have to discount that bond to convince someone to buy it from you to have that lower interest rate locked in for another 20 years. So longer term bonds, therefore, are more volatile, bigger up and down price swings, and therefore have a higher risk to them than short term bonds. So which one also do you think has a higher interest rate, a higher coupon? Long term bonds or short term bonds? What do you think? This is audience participation time. Short-term bonds would have a higher interest rate. Okay, which one has less risk? Short-term or long-term? Lower, right? Okay, exactly. Yes. Shorter-term bonds will have a lower interest rate because there's a lower risk to them. Longer-term bonds, being locked in for a longer period of time, more susceptible to risk now, more susceptible to interest rate risk. Yes. Okay, more volatile. Okay. The little memory trick they have here, right, is the 3M, okay? 3M, which means maturity magnifies move. Okay, the longer to maturity, okay, the greater the up and down price swings, the greater the volatility. Volatility, remember, is the source of risk. Risk means uncertainty. That's what, if you think of risk means uncertainty. You can measure risk by measuring the volatility, or measuring the size of up and down price swings. Okay, Another thing, though, is the bonds with higher coupons, which have higher interest rates, have less volatility than lower coupon bonds. And the reason is, of course, see, the coupon is the interest rate that the investor receives. A 10% bond collects $100 a year. Well, it's calculating more money at a faster rate than, say, a 5% bond receiving $50 a year. Now, whenever investors receive cash, to at least some extent, that's going to offset the risk. So a 10% bond has got cash coming in at twice the rate as a 5% bond, so that it reduces the level of risk, it reduces the volatility. Okay, again, shorter term bonds are less volatile, longer term bonds are more volatile. Now, they might ask you questions like, okay, which one might be more volatile or less volatile, or have a higher degree of interest rate risk, or which one would have less? And they might give you ones with different coupons and different maturities. Don't worry about any kind of magic formula that says, okay, if it's this percentage rate but that maturity, this is the level of risk. It doesn't exist, and at least it's way beyond the scope of this test. So if you just remember things like, here's a bond that, okay, which one's bonds is going to have bigger up and down price swings or more susceptible to interest rate risk? This bond that matures in 2025 or this bond that matures in 2040? Okay, think of it that. Okay, now therefore, which type of bond would be most volatile of all? That would be a zero coupon bond. Why? Because it doesn't make any regular interest payment. There's no money coming in that helps offset the risk. Okay. All right. Now, by the way, the term that describes the effect of price movement in regard to change in interest rates, the word for that is duration. So the duration of the bond reflects how much impact that the change in interest rates have on the price of the bond. The higher the duration, the more volatile that it is, right? The greater the effect that price changes have on the market price of the bond, or interest rates have on the market price of a bond. Okay, now here's one. Now, we didn't mention these before, but some bonds, instead of having a fixed locked-in interest rate, have a floating interest rate or an adjustable rate or variable interest rate. That means the interest rate that it pays changes along with market conditions. So you have a 5% adjustable rate bond and interest rates go to 6%. This bond is going to start paying 6% too. So therefore, since the coupons are reset every so often, and they'll measure it against something like what Treasury bonds are doing or Treasury bills are doing, for example. So this reduces the amount of volatility, right? Because it's basically reduced, if not eliminated, the interest rate risk. Risk happens because bonds have a locked-in interest rate. 5% bond is always going to pay $50 a year, but now new bonds pay 6%. Well, if you have an adjustable rate bond, well, if the interest rates go up, they're going to start going up too and pay more. So it greatly reduces or eliminates the interest rate risk and therefore the price volatility. By the way, if the bond is a puttable bond, that means the bond holder can get out of that bond at $1,000, get their $1,000 back, at least at some point in time. So therefore, you have to figure if interest rates go up, the price of a puttable bond can only go down so far. Right? Because investors can get their $1,000 back. So it may not go below 1,000. Okay. All right. Here are other risks that come with holding bonds. One of them is purchasing power risk, also called inflation risk. Okay, because this is the risk that inflation is eroding the value of your investments while you're waiting for them to mature or to grow. If you buy a bond, a 10-year bond for $1,000, it means you get your money back 10 years later. Get your $1,000 back, but 10 years from now, $1,000 won't buy as much stuff as it buys you today. So that's our purchasing power risk. So you're hoping that the interest rate that it pays, right, will hopefully exceed the rate of inflation. And of course, there's a possibility that it doesn't. Okay, so that's the idea of inflation or purchasing power risk, right? And all bonds are susceptible to that. Stocks, by the way, at least give you a hedge against inflation risk, because stocks tend to grow on average at a faster rate than the average inflation rate. Depending on who you ask and when you ask it, but the rate of return on stocks is roughly 8, 9, 10% a year, while the inflation rate hovers usually between, generally speaking, between 2.5%, 3.5%. Okay, so stocks give you at least some hedge against inflation. Bonds, however, subject to purchasing power or inflation risk. Government bonds, of course, even more susceptible because government bonds are very safe, right? AAA rated, government guaranteed, which means they have a very low interest rate, low coupon rate. The thing is, though, right, while they have no credit risk or default risk, they're more susceptible to purchasing power or inflation risk. Okay. I remind people sometimes, okay, especially when I'm doing like employee benefit stuff, people tell me, oh, I'm happy making 2% of my money because I know it's safe. Here's the thing. If you're making 2%, but the inflation rate is 3%, are you really coming out ahead or not? Right? Not in terms of what that money will buy you. They're actually falling behind. That's kind of the irony. Okay, marketability risk. All right, this is a risk that a bond, well, how difficult or easy it will be to sell that bond without having to like really drop the price. Okay, like for example, real estate is generally illiquid, right? It's usually you can't really sell it quickly. So okay, some markets aside, but usually it takes a while to, if you want to list and sell a house, for someone to buy that house, unless you really want to drop the price, right? To get rid of it, right? To get out from under it. Okay. So marketability risk is how difficult will it be for the bond to sell. Now, government bonds, no problem, right? They're always marketable because there's always a high demand for government bonds because they're super safe. Corporate bonds might depend sometimes on the corporation, right? A AAA rated bond is more marketable than a triple C rated bond, okay? Investors generally do not like to have that kind of risk. Municipal bonds, however, now that could be a really big issue. There's not a very liquid, active market for municipal bonds. First off, they tend to be buy and hold investors. And also, there tends to be a thin market or a limited market for them. All right, we'll explain why when we talk about taxes, but basically this. If you own a municipal bond from your own state of residence, then the interest is not only federal tax exempt, but state tax exempt too. So if you own like a New Jersey bond, you're probably only going to be able to sell it to a New Jersey resident. Okay, so there's a marketability here. Liquidity risk is, it sounds very similar to marketability risk. There's a little slight difference between them. But that again, liquidity is how easily an investment can be sold without, again, it's like it says, without large transaction costs. Now again, lower rated bonds, right, are less liquid, right? Investors are not as enthusiastic about buying junk bonds as they are about investment grade bonds. So they tend to be a little less liquid. Corporate bonds, especially if it's like a hardly known corporation, for example, well, it might be a little harder to liquidate, to sell that bond because there just isn't as much of a market for it. Right? Okay. Legislative risk. Now, this risk applies to more than bondholders, by the way. Legislative risk is a risk that a change in laws might adversely impact an investment. Okay, so especially tax laws. So sometimes they're called taxation risk too, because municipal bonds that can be very, very susceptible to them. The big advantage of municipal bonds, when we talk about them later, is that the interest is federal tax exempt, at least generally speaking, and often state tax exempt too. But sometimes a change in laws affect that. And I can tell you something. There's someone I've worked with before. He's from Utah, and previously in Utah, all municipal bonds were tax exempt. So whether you owned a Utah bond or a non-Utah bond, they were all tax exempt in the state of Utah. Well, as time went on and the population of Utah started to increase, and there started to be more demand for things like roads and sewers and what you need to have a city and a town, they had to start getting investors to buy Utah bonds. So the law changed that, saying only Utah bonds would be state tax exempt. So that's an example of legislative risk. Other related things like a change, like say, for example, the tobacco industry. I said it's particularly susceptible to legislative risk. Colby, yes, you have a question? You may need to unmute.
Oh, my bad. I forgot to press *6. So I'm understanding the risk with these bonds, but could you explain just a little bit more or reiterate what you said on how bonds actually lose money?
Okay. All right. So how could bonds lose money? Okay. Well, one of which, of course, is change in interest rates, especially if interest rates go up, right? What they call interest rate risk. Interest rates go up, market price of bonds go down, right? Because they're not as attractive anymore. You own a 5% bond and new bonds pay 6%. your 5% bond does not look as good. So therefore, the only way you can convince someone to buy it from you is to discount the price and discount it enough so that their current yield is more like 6%.
Got it. Okay, thank you.
Okay. By the way, of course, what if a bond's credit rating is downgraded, right, from single A to double B or something? Well, investors don't like risk. Okay. All right. So if you wanted to sell it, you'd probably have to drop the price to convince someone to buy it from you, and say, until someone says, okay, for that price, I'll take a chance. Okay.
Got it. Okay.
Okay. Jason, I see your virtual hand is up.
Yeah, I was just wondering, like when you buy a bond, like for instance, you were talking earlier in the discussion, you buy a bond for $600, right?
Well, in that case, I was mentioning a zero coupon bond, right?
Zero coupon bond.
Right.
Okay.
So that's sold at a deep discount, right? Because it doesn't receive any regular interest payments, right? They bought them at a deep discount, and then they mature at $1,000.
So when you buy them at the discount, so is there any way in between the purchase date and of course the maturity date that you could add money to that bond, so that it increases
you can buy more bonds, right?
You just buy additional bonds.
Yeah.
All right.
Buy more
Those
bonds.
will all start at if you bought it 3 years down the road,
Yeah.
then those will start at that date, and of course continue on 3 years past
Right.
maturity date of the life. Okay.
Yeah. Okay. So yeah, I mean, you can buy more bonds, of course. Question here. Okay. Sorry. The loss to an investor feels. Sorry, let me check. Let me grab that. The loss to an investor feels different from compared to when the market has a bad day. Can you explain? The loss to an investor feels different from compared to when the market has a bad day.
So I think my question is when, like, I think for me, like, I think when I'm losing money, it's because the market took a big hit, right? And you see that immediately in your 401k. So that's what I mean when I say that the loss an investor would take on a bond feels different. But I don't really know how to explain it.
Okay. Well, of course, now we've all had, we've got 401ks, and we've had some days where the market took a big old hit. Okay. And we're looking at what happened to my 401k. Right. So that's part of it. Now, at that point, of course, it's just paper losses at that point. So, we're still adding to our 401ks, and since we're going to have a chance to buy more shares now, when markets are down, at least now we can buy more shares, for example.
But those are equities typically, right? So that are going to take that immediate hit versus, like, is the loss on bonds, it's a longer loss, right? It's not like as volatile, like up and down.
Well, generally speaking, I'd say that's true, right? Stocks are much more volatile, bigger up and down price swings than bonds are. Bonds are more stable. And of course, shorter term bonds are more stable than longer term bonds. Okay, so keep that in mind also if you get these questions about those what would you recommend kind of scenarios. So if it tells you an investor is wants to avoid risks, yeah, we're going to maybe suggest a short-term bond fund before we suggest a long-term bond fund, right? Because value is going to be more stable. Now, of course, the trade-off is a longer-term bond fund is probably going to have a higher yield, right? Longer-term bonds have higher interest rates than shorter-term bonds, but that's because they have a higher risk to them. So investors have to kind of decide, right, for themselves, is it a risk worth taking? By the way, if the test question says, right, things like this person does not want to have any kind of risk here, they're very conservative investors, always go with the safer strategy. Question says, unless you have too many and need to sell them? You mean like too many bonds, you mean? Or? Okay, yeah, I mean, if you find you're overweighted, for example, or maybe you have a certain liquidity need, right? People invest money as a means to an end, right, to a goal. And maybe they decide that, maybe they are overweighted in bonds, for example, right? Don't need that. Yeah, they might want to sell them at some point. Now, of course, the risk, of course, is with interest rate risk. If interest rates have gone up, their market price of bonds go down, and maybe they can't sell it for the price they hope to get for it. That's always a possibility. Of course, if interest rates go down, the market price of bonds go up, and they could sell it for maybe more than they expected. But yes, so part of that might be, for example, like rebalancing a portfolio, right? You have a certain, master plan about what percent do you have in different types of investments. And you might decide, maybe your investment's kind of overweighted in one or the other, and so you got to move some money around, right? Sell some stuff and use the proceeds to buy something else to get basically back to your ideal mix. Amy, I hope I'm helping answer that question, and if I'm missing the mark, please let me know. If I'm doing okay, please let me know too. Oh, all right, great, thank you. Okay, okay. What else we got here? Let's see, check this one here. Okay, all right. Okay, we mentioned legislative risk. Okay, change in laws, especially tax laws, might affect an investment. Call risk, we've talked about that. A bond with a call feature gets called away early, gets cashed out prematurely. Investors get their money back, but now they got to reinvest it someplace else, and they can't get the same rate of return they did before. Business risk. Okay, now this is risk to basically means you've invested, you put your money invested in a business, and that business is not performing as expected. All right, and maybe the value of its investments reflect that less than stellar performance. Maybe even its rate, it gets downgraded, and a downgraded bond is now riskier, and investors don't want risk, so the market price of that bond goes down too. Okay, now as it says here, you can diversify, right? You can spread that around by buying different bonds in different companies and industries, and that's of course where mutual funds come in, right? Because you buy into a big basket of like hundreds of bonds in different companies and industries and spread out that type of risk. Okay. Prepayment risk. This is risk especially to mortgage-backed securities. Okay, so in a mortgage-backed security, a bank creates a mortgage for someone to buy a house. The bank will then sell the mortgage to a government agency or maybe to an investor. So that way the bank has more cash and can create more mortgages and get more mortgage origination fees, okay, and also pass the risk on to somebody else. Now the agencies are going to take these mortgages that they bought, basically create a big pool of mortgages, rebundle them and sell them to investors so that investors get income when homeowners make their mortgage payments. Prepayment risk happens when, well, those mortgages get paid off sooner than expected. More likely to happen, of course, if interest rates have gone down and homeowners start refinancing their mortgages. Right? They get a refinance, they pay off the old mortgage and get a new mortgage with a lower interest rate. Well, whoever bought that mortgage, right, gets their money back. They get their principal back before they expected to. Now they got their money back, they'll have to reinvest it someplace else. And if interest rates have gone down, they won't get the same rate of return. It sounds a lot like call risk, except it's just more precise, right, to mortgage investments, mortgage-backed investments. So Kimberly says 2008. Yes. Okay. The subprime housing crisis. Yes. Okay. Reinvestment risk. Also, okay, if you own a bond, you get interest payments, right? Every 6 months. Now, unless someone's going to spend that money, they're going to put it back to work. But if interest rates have gone down since that bond was created, they won't be able to reinvest that money at the same rate of return as they had before and also face a loss of income. Now, zero coupon bonds aren't subject to reinvestment risk because they don't make interest payments. There's no cash flow coming in that needs to be reinvested. Sounds a little similar to prepayment risk, except again, it's just a little more precise as to the exact cause of that risk. Okay, Colby, are you okay? Colby, you still have your hand raised, or is that from before?
That should have been from before. I'm sorry.
Oh, okay, no worries. Okay, we just take that lower than just so that. Okay, but Karina, your hand is up.
Yeah, could you explain to me why a prepayment is a risk, like being paid early rather than later?
Well, it's a little like call risk, isn't it? Right? The bond gets called away from investors. Investors get cashed out early, prematurely. More likely to happen, of course, if interest rates go down. And they get their money back, but now they got to put their money back to work someplace else, reinvest it someplace else. But now interest rates have gone down, they can't get the same interest rate they did before. Prepayment risk is like that too, except it's more precise to mortgage-backed securities. The mortgages get paid back earlier than expected. When I refinanced my mortgage, okay, well, it was good for me, but somebody bought my mortgage. I know my mortgage got sold to FNMA because I got a letter that told me that. All right, but so whoever bought my mortgage, well, basically they got that prepayment risk. So, okay. So,
Thank you.
Okay, sure thing. Okay, currency risk, also called exchange rate risk. Well, that would apply to foreign investments. And we touched on that when we talked about ADRs, right? You have you have foreign investments in foreign, so the interest payments, the principal payments, are repaid in yen or euros or pounds or Australian dollars or shekels or pesos. Okay, and well, if the exchange rates become less favorable, you don't get as many dollars for the same amount of yen or euros or pounds or pesos, and so right then the value of the bond goes down. Okay, and the value of the principal amount can go down too because you can't get as many U.S. dollars for it as well. Okay, so that would be currency risk or exchange rate risk, but that only applies to foreign investments. Okay, political risk also applies to foreign investments. Sounds a little like legislative risk, but this is for foreign investments. That's the risk that, well, you have investments in another country, and the company changes its procedures, its policies, its regulations, its laws. A coup d'état, okay, right, might adversely affect your investment. I would say, for example, Brexit. That was a political risk because, for a while there, it was like, we don't know what's going on. We can't figure out what's happening here. And risk means uncertainty. So that would be an example of political risk. Okay. Now, when it comes to risks are going to be categorized. They're going to fall into two major categories: systematic and non-systematic. A systematic risk is a risk that's basically inherent to the whole system. Any investments in that category face this systematic risk, right? And you can't really diversify against that systematic risk. See, systematic risks are risks that affect the whole market, the market risks, right? Your investments are down because the market's down. Now, sometimes they categorize certain risks as being systematic, like interest rate risk is a systematic risk. All bonds are affected when interest rates go up, price of bonds go down. It's just sometimes a matter of degree. Okay, so you cannot diversify away from the systematic risks. Okay. Non-systematic risk, inflation risk too, by the way, is also a systematic risk. Non-systematic risks are not ones that are inherent to the whole system. Those are risks that are individual to a particular investment or a company or an industry. Okay, things like default risk is a non-systematic risk because if you put all your money into one company and that company goes out of business, well, guess what? You're out of business too. But you put your money into a bond fund with hundreds of bonds in different companies in different industries. All right, maybe a couple of them go out of business, but hundreds of more are still working, right? So you spread out the non-systematic risks. Okay, yes, Karina.
Could you explain the difference between legislative risk and political risk?
Legislative risk is domestic and political risk is foreign.
Perfect, thank you.
Okay, sure thing. All right, well, that actually brings us to the end of the section, and we're exactly at a quarter to the top of the hour, which is exactly the time I'm supposed to let you out the door. So this worked out like super perfectly. Thank you, Kimberly, for the virtual applause. All right, before we wrap up, is there anything we haven't covered? Is there any part of that you want to ask about, get some detail about? A practice question that maybe you need some more detail with, okay? Okay, and remember, my offer to you still stands. All right, you want to we can set up a time to talk, one-on-one, 15 minutes about any topic you like. Or if you want to email me, copy and paste to one of those practice questions. Go, I can't figure this out. They said the answer was C, but I'm sure it was A. Why can't I figure this out? All right, copy and paste and send it to me, and I'll help you walk through it. Okay, well, with that, unless anything else at all, real quick here? Anything else? Okay.
Where should we be? I'm sorry. Where should we be caught up to with the material by Monday? Chapter 3.
Monday, it'd be great if you're done through the stock and bond section by Monday.
Okay.
Okay, I think that would be pretty awesome. And if you had the chance to get into any other sections, right? No rush on it, but if you do find yourself available to. Okay. Again, my biggest suggestion to you through this whole thing is do something. Make sure you're doing something on a daily basis. Reading, taking practice questions, but whatever you do it daily. Keep the momentum going. Okay, that would be one of the best things you can do, because if you give it some time in between, you're going to start losing momentum. Okay, thanks, Colby. Yes, you're right. Thanks, Colby. Because I've worked with a lot of people who say, well, I'm going on vacation for a week or something like that. And I kind of grit my teeth and say, okay, while you're on vacation, just make sure, tell everyone, you're not available from 7 a.m. to 8 a.m., whatever it is, right? So you're doing something daily. Well,
Yeah.
so far nobody ever has. And when they come back to me after about a week, well, when they start and stop, well, when they start again, they just about start over, right? Because they
Yeah.
lose that momentum. So that's
Yeah.
my best suggestion to you is keep momentum.
Okay. Thank you.
All right. Hey, it's my pleasure, folks. We'll see you again on Monday. All right. And again, as always, bring your great questions along with you. And thanks for being here. And thanks for your participation, right? Getting all interactive like this. This is what makes it fun for me. I will, okay, I got to hit the pause button on this video thing. Let it render. This will take a little time to render. And then I'll see if I can work out how to upload it to YouTube, right? SEC has this YouTube channel, and I'll see if I can still do that. If I can't do it, I'll put it probably on my own personal YouTube. All right. Take care, everyone. We'll see you again soon. Bye-bye.